Hello and welcome to Scalable CTO. I'm Bob Dickinson. This episode is the origin story, lessons learned from 15 plus tech startups and $500 million in value creation. So what is Scalable CTO? First line of code to tech leadership at scale is the tagline. I started my career like most CTOs as an engineer, building code and building products, and sort of grew throughout my career through a series of roles and eventually became a technology leader and a CTO, which is the normal path that CTOs go through. But I think the thing that's maybe unique about my experience and the thing that I can bring to this conversation, maybe a little bit different than all the other great CTOs out there who are podcasting and blogging, is that from that CTO position, I went back to becoming a founding engineer and built another product on another team and became a CTO again, and then went back to becoming a founding engineer. And I've done that a bunch of times throughout my career. And I'm actually doing that now, having left a couple of CTO roles at scale-up companies, and I'm now a founding engineer of a new startup. And I think the thing that's interesting about that for me is that it gives me some insight. So when I'm building something as a founding engineer, I know how it scales, how the technology stack scales, how the teams and the people scale around those kinds of things as the businesses grow. And I think that makes me a better founder. It makes me better able to sort of build something knowing where it's going. And on the other end of the spectrum, when I am leading a team, and sometimes these are teams that are not teams that I built that I come into, to build an effective team, you need to be good at hiring people. You need to be able to assess talent. And I think having technical skills, understanding the nuts and bolts of how things work at a technical level and being current on those skills is helpful in that kind of talent assessment. And I think the other thing is you need to have a lot of trust in your team, but you also need to be able to inspect their work and understand what they're doing and be able to help guide them and to make good technical decisions and be able to avoid risk by understanding at some level the nuts and bolts of the work that's going on. So I think having that skill set at scale is also pretty helpful, and it's tough to maintain both of those things. So I think that's the thing that I try to do, and that may be what makes me a little bit different than some of the other voices that you hear out there. So the highlights of what we're going to talk about in this episode, I'm going to kind of go through my career. It's hopefully a little more exciting than just reading my LinkedIn. I founded 3 bootstrap startups that all had nice exits. None of them took outside investment. They all had co-founders. In each of those cases, I went to the acquiring company and built the team, scaled it up, scaled the product, built a real business around it. And I had a number of different roles in those acquiring companies, but they were all leadership roles in one way or another. I founded a bunch of bootstrap startups that went to zero, which is sort of a shame. And I have a little bit of love in my heart for all of these things and wish they could have worked out. And I'll talk briefly about all of them. I've been hired into CTO roles at some scale-up companies. I'm coming in to manage existing teams of 50 or 100 people, and I've had some success doing that. And while I've been in role at CTO, the value generation, I don't take full credit for it, but the value creation while I was in that role was about 500 million. That's primarily between WorldTalk and OneLogin. And the total liquidity generated for shareholders, about 750 million. So I've had some success. My first job out of school was at Boeing. I took that job mainly because I moved to Seattle to train in rowing with my double sculls partner. We were Olympic hopefuls and trained for a couple of years toward that goal. So I needed a job in Seattle, and this was a great job, and it was a job that I could actually do pretty well while training full time. It was a true 9-to-5 job. So I built quality data collection analysis systems for 3 different divisions of the company. And the quality focus at that time wasn't really about safety. It was really about cost. The Boeing was really good at using a massive amount of inspection to ensure end product quality. So they caught lots of defects before they got into products, but they didn't really have a good set of systems for understanding the cost of those things and where the processes were going sideways and where they should invest to try to do process improvement and save money. So the systems I built were really around collecting all this data that was mostly on paper at the time, and then doing a bunch of data analysis around understanding what the problems were, how much they cost, where they originated, and where to go invest, and how to sort of measure whether those process improvement investments were effective. It was a true 9-to-5 job, which, I mean, a lot of jobs in that time frame were, because there wasn't any way to work from home. There was no email. There was, you got to work at 8:30, they kick you out of the office at 5, and there was nothing to do related to work after that. So you had all the rest of your day and your weekends to do whatever else you wanted. And I think the bar for performance wasn't super high. If you were really motivated and smart, you could do a straight 9 to 5 and take advantage of lots of other opportunities within that environment and still do really well. There was a ton of training available. That was kind of the deal I had with all my bosses, which is I wanted to be able to do any training I wanted to do. I did tons of time management, people management, all kinds of things, technical training, which was great, and they were great on that front on development of employees. The pay wasn't great. It was fine. The pace of career advancement was pretty slow. They actually had a rule that you had to be in a role for, I think, 2 years before you could be considered for a promotion or a raise. I found a loophole, which was that if you went to a different division of the company, these divisions are sort of like separate operating companies, that you could get hired into a role above the level you were at. I think they closed that loophole at some point, but I was able to move to a few different divisions and essentially rebuild similar systems at each division and get a promotion each time. But that was pretty hard to do. And I don't know that the work was super meaningful. It wasn't something that people really had a passion for. I mean, it was fine. But I think in a 9 to 5, you can grow and you can learn and you can make money to support yourself, and you can invest in yourself outside of the 9 to 5, and you can find your passion somewhere else. This is sort of the Rick Rubin, philosophy. And in my case, I was able to train full time. I was able to do side hustles. I was learning programming. I was doing shareware. I was writing magazine articles. I was running user groups. So I had tons of time and energy to really build what became my career later, while doing this 9 to 5 during the day. And I think it was the right thing for me at the time. It was definitely very different. It's essentially the opposite in every way from a startup, if you look at those bullet points. So the Olympic dream didn't really work out for me. And I think when I realized that wasn't going to happen, I wanted to find a job I could really throw myself into fully and get into the startup world and get into technology. And so I found my first job pretty easily because I'd had a lot of connections and done a lot of networking during that off time on my 9 to 5. So I joined a company called ConnectSoft, who was a pioneer in e-commerce. They had products selling clip art and fonts via dial-up. So they were doing e-commerce where you could literally search an online catalog of products, buy them, pay by credit card, like predating the internet. Nobody else was doing anything like that at the time. Pretty groundbreaking. We had a large software development consulting business. We had probably at one point 100 plus engineers building Windows applications for some of the biggest software vendors in the world. And we had our own products. We had a great multi-protocol email product. I started as an engineer there, and I kind of worked my way up, managed projects, and then eventually teams, and was eventually VP of engineering and a GM and a board member. And that company was very close to becoming a huge success. We were within a couple weeks of an IPO. We were working on the final paperwork. The bankers were all lined up. And if a couple of dominoes had fallen differently, I mean, just a couple of things had gone differently, that company, I think, could have been a huge success. And it could be one of the companies that we talk about now as being one of these pioneering, still existing companies that drove the development of the internet. We had some great technology. We had an awesome web browser. We had an ISP. We had a bunch of pieces, but we just couldn't bring it all together. And I think one of the lessons there is really that startups require 100% commitment. A true startup where you're trying to change the world, and you're trying to build something awesome, and you're always underfunded, and you're always under the gun. Like, everybody has to be 100% committed. That the amount of hours you have to work is insane and not sustainable. But that's just sort of what's required, I think, when you're trying to build something awesome. And also that company hypergrowth is a great opportunity for personal growth. There's no way that you're going to join an existing company and get promoted from being an engineer to, running a team of 100 people and be a VP at 27 years old, other than in a startup, other than in a company that's growing and needs somebody to do that role. And you have the ability to sort of step in and do it. And I have a bunch of friends who are startup people who have similar origin stories to this, where they sort of got into these bigger roles and developed that experience and learned under fire, because they were in a situation like this where somebody needed them to do that job, and they stepped up and did it. So that was a great experience for me. I learned a ton. It's too bad it didn't work out. Could have been awesome. It was close to it. I left there and I started a company with 3 co-founders, Blake, Ron, and Dave. You'll see some of these names pop up again on some of these other stories. And I started a company called Deming Internet Security. Deming's my middle name, just in case you're curious. So we did some software development consulting. That's kind of how we paid our bills. That's how we were able to survive without raising any capital. We had a secure email toolkit. So this was like very, very beginning of secure email. And we had a bunch of people who had, well-worn copies of applied cryptography on their desks and were involved in standards groups. So we built a toolkit on top of the core cryptographic algorithms to make it relatively easy to do secure email. And we had licensed that to some software vendors. And we were building our own product. So we had a secure email gateway product, which was a pretty cool idea, I think. But the idea was that you would have this SMTP relay that you would stick outside of your mail server. And your trading partners would stick one in front of their mail servers. And all the email that you sent back and forth would be encrypted and signed. So you didn't really have to do anything. You just put these two servers in your two data centers, and now all of your email was encrypted and signed. And that had some interesting applications at the time. There were law firms are still using faxes because there was no reasonable expectation of privacy on email. There's no guarantee that email had been tampered with or the contents disclosed. So we thought that was a pretty cool idea. We got an offer from Microsoft might not have been 6 months, might have been 4 or 5 months in, that we turned down. We sort of sent them packing and didn't even let them leave the offer because we were so disgusted by it. And that was kind of a funny story. They called and got in touch with us and wanted to talk about acquiring us. And I basically told them I wasn't interested because I knew they weren't going to pay us any real money because we didn't have we didn't have really a lot of IP at the time. And I didn't want to just we didn't leave a company and do a startup so we could be acqui-hired and be back working at Microsoft 4 months later. And they assured me that that was not a problem, that the price would be whatever the price would be, that, they would be able to come up with a deal that we would like. And so we kind of reluctantly went along. They interviewed us, put us through a whole day of these panel interviews. And then they came back with an offer that, it was basically an acqui-hire. It was a bunch of stock options. It was pretty generous stock option grant, and then some additional stock options that were half in the money. And we turned them down. We told them to take a hike. Now it turns out, had we taken that deal, that would have been worth about $100 million each, 30 years later. So how could a deal be worth $100 million and still be a shitty deal? I think the answer is that that presupposes that you knew Microsoft was going to 300x over 30 years, that you work there, that you earn the options out, that you exercise the options without selling any of them to pay for the exercise cost, and you hold that for 30 years through a lot of ups and downs. And I guess the other question would be if you went back and said, okay, well, if you knew Microsoft was going to 300x in 30 years, there were a lot of other ways you could have gotten rich that didn't involve selling your company to them and going to work there. So anyway, that's a little painful to look back on, but part of the story. So we were acquired by World Talk Communications, was a public company at the time, after about 12 months of operation. And my lesson learned there was sometimes, this has happened more than once to me, that you get acquired and the acquirer has a different idea about the value of the thing that you made. Not the amount of the value, but why it's valuable. And in this case, we had built the secure email gateway product, and it worked great. And we started realizing, oh, well, you have this problem. What if you get a piece of email and it wasn't digitally signed or encrypted, or the signature wasn't valid, or been tampered with, or something else happened? Or what if you were trying to send a secure email and you didn't have one of these gateways set up to one of the trading partners, and what do you do? So we ended up having to build this policy system to handle all these exception cases. So we had quarantines where emails would get set for the side, where an operator would go look at it. We'd have these policies that would maybe return an email to the sender, or that would annotate the email to tell them that, hey, this was supposed to be signed or encrypted and it wasn't, so it's maybe kind of sketchy. So we built this policy engine to handle all these exception cases. And then what it turned out that WorldTalk wanted was they wanted a policy engine for email streaming, and they didn't really care about the encryption case that much. They had other ideas about what they wanted to do with it. They wanted to do anti-spam and antivirus and data leak prevention and, detecting PII and all kinds of things like that. So they had a bunch of other ideas, and they had started to work on a product like that and saw what we had and realized that it was going to be a big shortcut for them to be able to bring in the technology and the team. So pretty different idea of why they wanted us. So WorldTalk was a public company. This was called the good old days. They were about 20 million in revenue, about 100 million market cap, and you could be a public company at that level back then. Before Sarbanes-Oxley and all the regulations that got put in place. Now you probably have to be closer to 250 million in revenue to be able to just cover all the expense of all the compliance that you have to do to be a public company. But back then there were small cap companies that were public. And that meant that the founders and employees had liquidity. It was just sort of a different world than we live in now, where, companies like Stripe get to $100 billion and they're still private and still burning through venture capital. So we grew the team. We hired some people. We built a bigger product around it. We ended up building this product called World Secure Server. That was pretty awesome. The interesting thing about that company was the WorldTalk had an X400 directory synchronization product that was their 100% of their revenue. And that product pretty much went to zero on a straight line over the 3 years that we were there. And we built our product from zero to about the 20 million that it used to be. So revenue was pretty much flat over the 3 years, but it changed completely from being this existing legacy product to being the product that we built. And then after that 3 years, the company was sold to Tumbleweed Communications for 230 million. Tumbleweed was also public at the time. So I started there as a director of engineering, running my team, and eventually got promoted to VP and then eventually to CTO. That was a great first-time CTO experience of a public company. So being part of a management team and being in that role was great. And I was in my early 30s, which again is sort of hard to do in a traditional career track. Like starting companies and being acquired is a good way to get into those kind of roles earlier in your career. So one of the lessons I say is when you're being acquired for stock, you need to think like an investor. And we didn't really do that. We were like, hey, they're giving us all of this stock and the stock is worth real money because it's a public company. You can sell it and it has value. And we didn't really look at the business as an investor and say, would I invest my money in this stock? What are the fundamentals of the company? Because we probably would have been able to see that those legacy products were not strong. And we didn't really do that. That's maybe one thing I would say is if you're being acquired for stock, you are an investor. Imagine you're spending cash on that stock. Would you buy that stock for that amount of cash as an investor? And the second thing I learned there was this was really my first foray into enterprise sales, and that we would sell these big ticket sales. We were selling packaged software, so it wasn't a SaaS model. And it would be awesome. They would sell a deal. Oh, hey, we just sold Fidelity for $2 million or State Farm for $2 million or something like that. And the salespeople would be super excited and they'd take you out for a beer to celebrate. And then over a beer, after a couple of beers, they'd say like, there was this one thing that we had to agree to. They have this thing that they need us to do, this feature or this whatever. And it was a lot of money. And I would have done it. I would have taken the deal. So we had to do it. So we're okay, great. We'll go spend a week or two and we'll build this feature for this company that nobody else wants and maybe doesn't even make sense, but whatever. But then you do another one of those and you do another one of those. And now you have all kinds of feature flags in the code where everybody's running different binaries because everybody has a slightly different feature set. And then the feature sets start to conflict with each other. It just became a total nightmare. It was unmanageable. And I just had to sort of file that in the back of my mind to never get in that situation again where customer customization, which you will definitely have to agree to, requires you to change core code like that. So to really think about integration scenarios and customization scenarios when you're building the software so you don't end up in a situation where your whole engineering team is just sitting around building customizations for enterprise customers. So I left there and I started another startup called MovieCentral.com with Ron, who is one of my founders from Deming. We both put some money into that company. We were an early application of collaborative filtering. We didn't really call it AI. I would have been a little bit ashamed to call it AI back then. I think it's as much AI as the things people call AI now, but maybe that's a digression for another time. But it was machine learning. It was Bayesian networks and neural networks and oriented around prediction. So sort of a lot of the same kind of matrix factorization that exists in current prediction algorithms, but very, very early before people were really doing this. We were self-funded. We had some angel investment. Tim O'Reilly from O'Reilly Publishing was one of our investors. We had launched a site. We had some basic working technology. We had a $2 million seed round ready to close. We had a strategic investor, Macromedia, who we'd been working with and cross-licensing some stuff with. And we were ready to go. We were ready to really scale it up. And this is at a time when there had been a boom in the dot-com world that had been going on for years. Everything that people started got funded. Everything worked. And it seemed like it would never end. And then it ended. The dot-com crash happened right as we were waiting. The deals were done. We were just waiting to sign the deals when the dot-com crash happened, and it all went sideways. And it wasn't just us. It was every venture investor shut down everything. Nobody got money. Everything died that needed cash to survive. It was just a massive overcorrection, and there was no way we could fund it. And we kind of made the mistake of assuming we'd be able to raise that money. And this is, I don't know if it's a mistake, because when you can raise the money, it works. But businesses that rely on these continuous rounds of funding, you grow fast and you spend and you assume more money will come. And that was kind of the mode we were in. We were spending more money than we should have because we thought that we had every reason to believe that we'd be able to raise more. And then we ended up with a business that, had some awesome core technology, but just couldn't survive without cash. So I guess that's the first lesson: is relying on continuous cache injection is risky, because sometimes things out of your control happen that make that not happen. And all booms come to an end, and they all overcorrect, I think, and that's something to think about in the context of AI now. That there were solid fundamentals that drove this. The boom was basically the boom of everything moving to the internet, which happened, which is the market that we live in now. But it was just overinvested. There were too many deals that were too crappy in retrospect, and people started wondering if we really needed another dog dating site, and all of a sudden everybody got punished. And that'll probably happen with AI at some point. It doesn't mean it isn't the way of the future. It just means that there's too much enthusiasm and gets corrected. The technology was really cool. It was a little bit odd in that we had some of the same problems that we have with AI now, which is that we had this awesome neural network, and you could make these predictions, but you couldn't really explain why you made the prediction. So we would see a lot of competitive prediction technology that would say like, oh, we think you're going to like Terminator 2 because you liked Aliens, or some other popular movie, and people would be like, oh yeah, I did like that movie. I guess maybe I will like this movie. And so when we tested that a lot, and I think what we found was that people really liked that reference of, I'm going to tell you why I'm going to make this recommendation, not just trust me. And our engine was really a trust me engine. It was really about identifying oddball, quirky things that you specifically would really like. And then you have a time to take the risk to trust that recommendation and go find out it was true. And it did work. I mean, we had the numbers, the math worked. Like it gave great recommendations. But it wasn't a great business model because people didn't really necessarily trust them. So I don't know. I think we could have solved all that if we'd have been able to keep going, but we didn't. So we had to shut that down. And then I started another company called Brute Squad Labs with Blake Ramsdell, who's one of my co-founders for many of these, one of the original Deming co-founders. And we started out to build this piece of core technology that we called the Business Logic Unification Engine, but it's basically a policy engine that could apply logic to any data or any protocol. So the idea was you'd be able to build this custom logic with this domain-specific language that we built, and you'd be able to apply that to anything. And we needed some kind of proof of concept for like, all right, what's an example of something you could do with this? And because we were kind of email experts, we built an email gateway and we attached this content processing engine to it. So when email would come through it, it would process the email, it would extract the plain text from documents, which was sort of a hard problem that we had to spend some time working on, especially back then. These documents were all like binary files that were hard to crack open and get the text out of. And then we could apply these complicated logic and rules and build all kinds of cool custom stuff. So that was pretty exciting. It's the best code base I've ever worked on. It was about 500,000 lines of code. So that was two of us working 80 hours a week for 18 months, pretty much nonstop. It had about 5,000 unit tests. We were in the early days of extreme programming, and we were really big on unit testing everything. Unit tests are the documentation. Unit tests are the proof. Unit tests are the validation. It was a mono repo, so you could make big, giant refactoring changes fully safely. Like you could touch 100 files, 500 files in one go, make sure the unit tests pass and check it in. And I said we have CI/CD before that was a thing. We basically had a rule that said we run the unit tests at midnight, and if they pass, we deploy. Our production mail server is deployed from our dev code, and that's how confident we were that those unit tests were the definition of the system, that if those tests passed, the system worked, period. And it really gave us a lot of flexibility. I mean, we were able to make a code base that grew, they got large, they got really complicated. And there was really no tech debt. There was no like, oh, I'd like to go change that, but I'm afraid of it. And so that to me has sort of been an inspiration for every code base I've built since. I don't know if I've ever quite equaled it, but definitely inspiration. And that's kind of my lesson learned, that the automated testing is really everything. It's the only way to build big code bases that scale, that allow you to avoid tech debt and continue to move fast. You have to have full automated testing that you completely trust to validate the system. And if you have that, then you can get away with a lot of other things. So that company was acquired by SendMail. We did not intend to build a similar product to the product that we sold from Deming to WorldTalk, and we kind of accidentally did. SendMail saw this thing and said, oh, hey, this email gateway you have, and we had a SendMail Milter plugin for it. That's pretty clever. We've been thinking about a product like that. And a lot of our SendMail customers want us to solve some of these similar problems. So they bought us to go build an email policy gateway, basically. So we went to SendMail. We turned that technology into a product called Mailstream Manager, and then later Centrion. and built a pretty significant business around that. And after our earnout was complete, we stayed on and supported and continued to extend that product under a royalty agreement. That was eventually sold in kind of a fire sale many years later to Proofpoint for $23 million. I had a good time at SendMail. I think Blake and I both did. We were still actively, coding and managing this growing product line. But the lesson I learned there, and this is one of those things where like you can know something, and then when it affects you personally, you really understand how it works. So I understood the principles of how dilution worked and how preferences worked in investment. But until it actually impacted me directly, I'm not sure I really appreciated it. So when we did the deal with SendMail, we got about 5% of the common stock of the company that we had to earn out over time. And as shareholders, we were able to get a good look at the cap table, so we understood who the investors were and what their preferences were. And we were fine with that. But then what happened was, as their sales were flat for a long period of time, they had to continue to take more investment. And then eventually some of those were down rounds where they were taking investment at lower valuations because they were still not profitable. So they still were burning through cash. And every investor who came in got a little bit sweeter deal than the investor that came before them. So the existing investors are basically saying, hey, this thing looks like it's not going great. I don't want to put any more of my money in there, but I also don't want it to go to zero. So I'm willing to let somebody else come in and give them some preferences. And what the preferences are, essentially, a company will go to an investor, and you don't always have to give these up. If you're in a strong position, you don't necessarily have to give up preferences, but oftentimes this happens where an investor will come and say, hey, you're telling me if I invest, you're going to give me twice my money back. I'm going to make twice my money or more. So how about we do this? How about you just guarantee me twice my money back? So if you sell the company, you're going to pay me the $5 million I give you now, plus another 5, which represents my profit, before anybody else gets anything, including other preferred investors. And so when you start stacking these things up, you can end up in a situation where, you might have a company that has 100 million shares outstanding that sells for $100 million. So that's $1 a share. So you have some shares and you think you're going to get $1. But what happens is the preferences start getting taken out. So the Series A person takes their preferences out, and then Series B, then Series C. And so before you know it, $80 million is gone to cover the preferences, and all the rest of the shareholders get a split $20 million and not $100 million. And that's basically what happened here. There was so much dilution and so many preferences that by the time they sold, the common shares were worth zero, literally zero. So 5% of SendMail common stock, 5% of the total stock at the time went completely to zero because of all these preferences and all these down rounds. So owning some percentage of a company does not mean you're going to get paid if they get sold. You really have to understand the preferences. And to some extent, it's out of your control because common shareholders typically don't have any rights and they aren't really represented by anyone. In theory, by the management team, but really the management team works for the board, and the board represent the preferred shares. The preferred shareholders are the ones that have all of the power in those agreements. So if they want to dilute the common shareholders, they typically can do that. And you don't really have a lot of say in that. So it's very difficult as a common shareholder to understand your value. In this case, that was zero, which was kind of a bummer. We still did fine in that deal, but because of the royalties, but the stock went to zero. I left after that to do a company called Kazoo. This was a really cool concept that I really liked. It was with two Steves, Teglovic and Ashby. Steve Teglovic I'd worked with at ConnectSoft. He had gone and started a company called iShip that sold to Stamps.com for $305 million in like 2000, 2001. And the idea we had was, at the time, there really wasn't digital video. YouTube was just sort of starting. There wasn't really a lot of online video. And everybody had a box of these tapes. Everybody, especially if you had kids, you had a box of these tapes. They were mini DV and compact VHS, and they were like camcorder tapes that you shot. And nobody ever did anything with them. Like I had one of these boxes. Every venture capitalist we sat down with, Steve had a prop where we would plop this box of tapes down on the desk, and everybody said, yeah, I have one of those. And nobody had done anything with it. Like only a few people had ever like actually captured the tapes and like made an edit or done anything with it, or even watched them again. So our idea was, we're going to take all this video that you have, we're going to put it through like a robotic process to record it all high speed, and then we're going to have some technology that automatically cuts that into labeled video, and then makes edits out of that, actually makes movies that you can watch out. It makes home movies for you. And we thought it was an interesting idea. There was a lot of positive reaction. Every venture capitalist that we talked to, and we got a lot of good meetings, particularly because Steve had a good track record of having made some of these guys some money. They all love the concept. They all love the idea of the product, but it was kind of a big risky investment, right? Online video didn't really exist. We had to build a lot of things to make this work, and it was a decent sized investment. And I was disappointed by one thing in particular, which is that Steve had made some venture capitalists a lot of money. And he let some venture capitalists into a bridge round that he didn't really have to do, and they made even more money. And so I sort of feel like, hey, if you've just made these guys a lot of money, and they're all talking about it's all about relationships and investing in people and teams. Really, it shouldn't be that hard to get one of these people who've just made a ton of money off your company to put $1 million or $1.5 million in as a lead in a round or a seed round or whatever. Like that should just be automatic. As long as you're not a complete idiot and your idea isn't totally terrible, you should be able to go follow that on. And it didn't work. I mean, we went to VCs who we got a lot of top meetings with a lot of people, but particularly the ones that he'd made money before. And they listened politely, but they really weren't interested in the idea. Didn't fit their portfolio strategy, didn't fit their investment philosophy, and they just didn't play ball. So that was a little disappointing to me. I think the other thing is that we really focused too much on building out this technology to scale it. Like we knew that this would only work at any kind of scale. You could only ever actually make a business that made money if this was all automated. And I think a smarter thing to do, we found a company later that had done this, that was doing it in India, was they did it manually. They just did it as super low wage workers, and they would literally physically manually put all these tapes in, scan them all, and cut together videos. And I don't think they made money either. But I feel like we could have done an experiment for a few $100,000 and done that, and hired some low wage, offshore workers and done it manually just to prove it out, just to prove, like, look at what our CSAT is, look at what our net promoter score is. Like, people love this product. They refer their friends to it. They buy add-on products, whatever. And really totally proved out the business case before we then went and spent $5 or $10 million building all these robots and all this technology. So I think that would have been a lot smarter way to handle that. It was just too big of an investment in things that was too risky without having really proven the business out. So didn't work. It's kind of a bummer. It's another idea that I really liked. After that, I started a company called Sign.in, again with Blake. It was a consumer-oriented password manager. So it would it's kind of like password managers work now, but this predated any of the current internet password managers. So you can go to a website, you could click some logo, Amazon.com, and it would take you to Amazon and log you in to Amazon. And so that was pretty cool. We also had these secure ID tokens that we bought and branded. So you could buy these from Amazon. I think they were $20, and we were one of the first people to use Amazon fulfillment and sold by Amazon to sell these things. And our theory was we'll kind of give away the basic product for free, and then we'll try to convince people to protect all their passwords that they have in this password vault with one of these secure ID tokens, and we'll sell that for $20 and make $10 profit. So that was sort of the business model. It was a hard technical problem because there were a lot, it wasn't like now where every browser is basically built on the same core code, and there's only 3 of them anyway. So even if they weren't, you didn't have that much of a problem. There were a lot of browsers. They varied widely on how extensible they were and sort of how pluggable they were to make them do things you wanted them to do. And it just became a hard problem to be to be able to log into any site from any browser was a bigger technical problem than I think maybe we were ready to solve at the level that we were at. The other part of this, I think, by the way, I later, worked with the founders of OneLogin, and OneLogin and Okta were both starting around the same time, and they were kind of going in a similar way. They just went B2B, sort of enterprise. And I think that had we gone that direction, I think we probably been pretty successful, but we were really trying to focus on consumer. I think really the lesson learned there, I mean, consumer's hard. They talk about these tar pits all the time about these, things that look exciting because you think hey, I'm a person, I would like this product. And so you build it for yourself. But consumer markets are tough, and particularly customer acquisition is expensive, and organic growth is a fundamental requirement. And by that, what I mean is we had a model where we would acquire a customer, and that customer would refer 0.5 customers. So that means that person refers 0.5 and that person refers 0.5. So for every customer you pay for, you get about 1.9 bar customers. Whereas if for every customer refers 2 customers, then those 2 refer 2, and that's 4, and they refer 2, and that's 8. Then you're buying 1 customer, and you're getting hundreds or thousands of customers. You have this what you consider to be organic growth, where your customers are bringing customers in. And with things like social networks, it makes sense because there's a little bit of a coefficient of coercion where you're trying to bring other people in to make your experience better. You're trying to connect to other people. But this is just a utility product for a person. So even though people love the product, our customer satisfaction, net promoter, reviews, everything was positive. They weren't referring their friends to it, and the market, and it wasn't really growing. And not a lot of them bought the token. So that was the other problem. Is where, hey, you have all your passwords in this vault. Don't you want to spend $20 to secure it? And people weren't there yet. This was one of the very first use cases of this kind of a POTP, token to protect, cryptographically protect something online. And I feel like people just weren't, they didn't get it. They were fine just trusting us to keep it secure with this master password in the browser. So we just couldn't make the business work. Kind of a bummer. Also something we liked. We left that primarily because we had a great opportunity to start this company called Switchbox Labs with Mike Sievert, who now runs T-Mobile. And Mike had a great career as a CMO, building lots of great businesses. And the idea was an internet set-top box concept that had a universal program guide that plugged into your cable box and integrated with your existing cable TV signal, but also allowed you to stream content. And this was pre-Roku, pre-Fire TV. So this is before any of this existed. You could sort of watch streaming content on your browser, on your PC, sort of on your phone, and then TV was TV. That was cable companies and set-top boxes. So we were trying to bring these experiences together. We built a really cool remote. That's not just a rendering. That was a physical device that we industrial engineered and built. Built a lot of really cool technology. We had this picture-in-picture video overlay concept where your cable TV and your streaming would be integrated with each other. Part of it was this universal program guide, so that would go across all of cable and all of streaming services. So you would just say like, "Hey, I want to watch this show. I want to watch Dexter," and it would say, "Okay, well, based on the streaming and cable services, sort of here's the ways that you can do that," and kept track of which episodes you'd seen and that sort of thing all in one place. I still can't imagine how that doesn't exist today, but it still doesn't exist. And then we had this automatic content identification technology, which is essentially taking audio snippets and bumping them against a server to be able to determine what content you were watching, and then show you related content. So we'd say like, oh, hey, you're watching the Seahawks game. We can show you a ticker with NFL scores or a link to buy Seahawks merchandise or whatever. And we can actually overlay that onto the screen of the Seahawks game from your cable box. So it was pretty cool. We weren't able to raise money. Mike, based on his reputation and relationships, got us in front of, like, this time was the A-list. This was Andreessen, Sequoia, Kleiner Perkins. Like, this was all of the top Sand Hill Road VCs looked at this deal. And I think their big problem was they were sort of scared of hardware and they didn't see any, like, we heard more than once, like, who's your hero? Like, who is a model for how this would work? At the time, Sonos had taken $85 million in a few rounds, and they were still going to take $300 more million in 10 years to get to an IPO. It turned out to be very successful, but the venture capitalists were not wrong when they sort of said, "Hey, this is not us giving you $10 or $20 million. This is us talking about spending hundreds of millions of dollars to build this market out." And so you're taking a lot of risk in a lot of areas, including just the financial model. What happens if the investment market goes south anytime in the 10 years between now and when when you've turned this into a real business. So I think a lot of people liked it, and nobody was really, really willing to commit to that. It's not just the A round. It's like 5 more rounds after that to make this thing into a business. And, there was a lot of trepidation about that. But we were able to sell it to Lenovo, who saw some value in a lot of the different pieces of technology. They were working on some similar things, particularly in China. They were interesting. They liked the idea of getting Mike to come there and be their CMO. So we went to Lenovo. That was an interesting company. Lenovo is interesting in that if you haven't lived or worked in China, it's hard to understand how big Lenovo is because there's no comparable brand in the United States. There's no brand in the US or in Europe that's as big as Lenovo is in China. It'd be like Nike and Apple and Walmart and Costco and Dell and I don't know, all combined. They sell not only every kind of PC, but consumer electronics, phones, tablets. They have 6,000 plus retail points of presence, ranging from giant warehouse stores to people selling, laptops on a donkey in a remote area of China. It's everywhere. It's a huge company. It was exciting because I think they were a pretty innovative company. They liked a lot of our technology. We spent a lot of time working on perfecting some of the patents that we had and building a bunch more patents around that technology. And many of those are granted, more than 10, like dozens of those patents I think have gotten granted. We got to work on a lot of cool skunkworks projects, a lot of like interesting cutting edge stuff, and spent a lot of time working in China, physically in China and in products for the China market. And Lenovo was a big company. Is a big company, and they were still pretty innovative, but it's sort of in their own way. They built a lot. They did a lot of experimentation. They really valued innovation. I was able, as a director of marketing, to go into the Lenovo executive committee and was many layers below them and show them work we'd done and ask them for a couple $1 million to go do some science experiment, and they said yes every time. They were excited about it. So I don't have any complaints about that, but I will say the thing that was difficult is the way that they innovate is they do a lot of planning and ideation, and they come up with some idea of something they want to build. And these things are hardware products, so they take a while. They take 18 months sometimes to bring to market. And they would kind of run that up the flagpole, literally all the way up the flagpole. So you would say, hey, we're going to build this set-top box in China, and it's going to look like this, and here's what it's sort of going to do. And it literally went all the way to the CEO, every project, all the way to the CEO. It boggles the mind that they have enough bandwidth to even have any understanding of how many of these things are going on, but that's how it happens. And the problem with that is that you get 9 months into one of these projects, and you say, like, in my sort of Western approach to this, you say like, oh, hey, something has changed, some new technology is available, something's changed about the market. There's a better way to do this. Here's this better way. It's clearly better. And everybody said, yeah, you're right. That's way better. Okay, that's definitely better. And you're like, okay, so we're going to do it that way. And they're like, no, we're going to do it the way we said we were going to do it, because I told my boss and he told his boss and he told his, like, all the way up, and we don't get to change that. And it was just hard to rationalize this, because I'm like, but we all agree this way is better. It's going to make the product better. It's going to make it more successful, more competitive. Yeah, we all agree, but we're not going to do it. We prefer you didn't keep bringing those ideas up and telling our bosses about it, because we're not doing it. And so that was, I think, where kind of push came to shove. I just had difficulty in that environment where, like, my job was to find a better way to do things, I thought, and really it was just do the thing we said we were going to do and deliver it. And it's a different style of innovation. Still a super innovative company. I have nothing bad to say about them. It just wasn't a good personality fit for me. I think the overall deal, I think everybody on both sides would say worked out great for everyone. So, but I was happy to move on. After that, I did a very brief startup called Curious. I'm not going to talk about who else was involved in it. It was kind of a train wreck, and nobody was really public about their involvement. But it was a bunch of co-founders. We didn't really know each other well. A lot of big egos, a lot of different ideas, people bringing their friends and family members in and trying to do acquisitions before we formed the company. It was just a lot of moving parts in a lot of different directions. And it eventually sort of fell apart. It was a kind of a clever idea, but probably not worth going into. But I will say that was kind of my experience with lots of co-founders and people that I didn't really know and trust, like know personally and trust and have a relationship with. And it was a little bit wild for me. And especially as it fell apart. And one of the big lessons, which is sort of obvious in retrospect, but maybe something earlier in my career I didn't really appreciate, is that when you start a company, it's just ideas. It's just people talking, right? That's how it starts. You're having a beer with somebody, you're having a discussion about something, and at some point it evolves into like, hey, why don't we start working on this? Why don't you go make a prototype and I'll put together a pitch deck and let's see if we can make something out of this. And at some point, probably before you get funding or really start, you'll form a company and you'll come up with agreements and you'll figure out your equity splits and your vesting schedules and whatever. But there's a period before that happens where everybody's working on it. And I think one of the things I would do and have done since then is to make sure if you're building IP that it's your IP until such point as you assign that IP to a company in exchange for whatever, for your stock vesting or whatever, you own that IP. So keep it in your GitHub repo, put a copyright statement on it has your name on it, and make it clear that that's your IP. And you're going to, if you make a going concern out of this and you go raise money, you're going to contribute that like everybody else is going to contribute whatever they've done. But if that doesn't happen, you own that code. And just make sure everybody's clear and understands that up front and that you protect yourself. So that's something I would advise. So after that, and this is still sort of in the afterglow of Lenovo, where I didn't really need to work for money if I didn't want to. I pursued a bunch of hobbies, kind of hoping one of these would hit. These were all solo projects. I built an RSS reader because that was something I was pretty passionate about. I built a mobile app because I wanted to kind of learn how to write native mobile apps. So I built this mobile app called Pixtomatic, which let you caption photos and make memes kind of early in that, when that was sort of becoming a thing. I built a 3D physics game engine, which was a pretty big investment because I wanted to be able to make kind of cool, like Angry Birds type games that used physics that ran on phones. So I built a kind of a cool physics 3D game engine. I never really quite got like a cool game out of it, but I did build a pretty cool engine. And I did some consulting for Corona Labs, some Lewis Seabridge networking work. I was using some of their tools that were kind of bad, and I just sort of offered, hey, I'm tired of waiting for you to fix these. Can you just let me fix them under contract? And I guess for me, the lesson was stay busy, right? I didn't have co-founders that were trying to pull me into something. I didn't really have a job that I wanted to go do, but I wanted to keep my skills sharp and stay engaged. And so I coded every day. I learned a lot, and it prepared me for a lot of the things that came after that. I left that to do Synchro Labs again with Blake, my many times now co-founder. And this was kind of came out of a little bit of the work that I had done before building mobile apps. There were a bunch of tools for building cross-platform mobile apps at the time, and they were terrible. Like the apps were terrible. They didn't look like native mobile apps. They didn't even look like web apps. They were kind of bad. And the web apps also didn't look great. The web experience of mobile apps at the time was also not good. So the idea that we had was, what if we could build something that rendered the mobile app using native controls on the mobile device, but where all of that presentation and all the logic was done on the server. So you would deploy an application on the server like you deploy a website, and it would essentially send down a view to the client, which would cause the mobile phone to display a native UX, and then you would interact with that UX, and those interactions would actually happen on the server. So you wouldn't have a front end, back end. You just have one piece of code running on the server that was your mobile app, and it was presenting itself on the device. And we actually got that to work. I mean, we had some cool apps where you're tapping away on something that looks like a native mobile app on the phone, and every time you tap a button, the code that runs when that button's tapped is running on a server somewhere and changing some value, and that's getting reflected back on your client, on your mobile device. It was pretty cool. React Native launched about a year after we started that, and everybody, I think a lot of people thought, and maybe they were right, that was going to be the way. We thought we still had some pretty big advantages over React Native, but it was free and from Facebook, and I think that took a little bit of the wind out of our sails. So we had some really good code. That was a hard code base to walk away from, because it was a great code base, and it was really cool, and we had some cool apps that we built on it. It was just really tough. Like, developer tools are a tough market. It's like a religion, basically. You have to convert people to your religion, and then you have to convince them to give you money to be part of the religion. That's a hard thing to do. I think if we had focused more on enterprise and less on individual developers, maybe we would have been more successful. We went to trade shows and we blogged and wrote white papers, and we sort of tried to shake the trees and find people that would like this. And I mean, when we finally grabbed somebody by the short collar and like make them look at it, I think people liked it, but it was just really hard to get any kind of traction, and to build a real business around that. So that was a tough one. And I was still kind of actively working on that when the next opportunity came. And that was to go to OneLogin. So a friend of mine was CEO there. He had actually asked me about that company before he went there, and I told him not to go because it had some security breaches, and I just thought it was a bad company. But I looked at it and kind of liked it, and Blake and I both decided to go there. So this is the first time in my entire career up to that point that I got hired into a job that wasn't because somebody acquired the company that I started. So every job before that since Boeing had been basically, I start a company, somebody acquires that, they hire me, I get some promotions, and then I go start another company. So this is sort of the first time I'd come into an existing team where I didn't write the first line of code and didn't really understand the technology at a deep level. And I started out, the idea was, let's just open a development center in Bellevue or somewhere on the east side in Redmond, bring in some people from your Rolodex, and let's just build a development center. And I was like, all right, that's fine. I can do that. That's not too hard. So hired Blake, and then also Ron, who we'd done a couple startups with. We built a development center. We initially sort of just said, hey, why don't you just give us all the stuff that you don't want to do? Just give us all the products. They had a core SaaS product and a bunch of ancillary stuff. We said, we'll just take everything you don't want to work on. So we took the mobile apps, we took some of the on-prem stuff, and we just built a team of people that were cool with building enterprise software. And then at some point they had some leadership changes, and I eventually took over all of engineering, and then eventually was promoted to CTO, and I ran all of engineering and live site operations for that company. And that was a team of, I think when I started, probably 50, and at the high point was maybe 120 total people in engineering and operations, decent scale. The product wasn't great. It was fine. I think through some really focused effort, we were able to get to Gartner Magic Quadrant leader and Forrester Wave leader over the course of a couple of years of investment. It was definitely a slow boat to turn around. It was also one of the least reliable SaaS products, IDaaS products out there. We had a ton of problems with that. We had a ton of customer churn related to it. It was the biggest challenge by far that I had as a leader in the organization. And we turned it around with a lot of investment over a long period of time, from being probably the least reliable IDaaS provider to absolutely the most reliable and scalable IDaaS provider. And then we sold that company to One Identity in 2022 in a deal that I think everybody was pretty happy with. So I learned a lot of lessons there. I guess the big one was the big technical challenges don't really get solved unless somebody owns them. When we started looking at these sort of the SRE and site reliability and scale problems and the challenge that we had around it, there were a lot of interesting core elements of the architecture that supported those kinds of solutions. There were people that had the skill set. There were people that were excited about it, but it wasn't anybody's job to solve it. It was we were running a feature factory. We were signing enterprise deals and signing up for lots of features and trying to keep up with Okta and trying to get on the Gartner MQ and do what they told us we needed to do. And so it was just, everybody was just working on building features all the time. And there wasn't a team of people. There weren't really a group of people that were focused on my job every day when I get up is to think about site reliability or about scalability. And so I think the big insight there was after looking at this problem and talking to all the people, and I'm like, I think we might already have the skills to solve the problem. I don't think it's a skill problem. I think it's a focus problem. So we built a platform engineering team. We eventually kind of merged that in with our ops team. So that was all one team. And at one point we went from having nobody working on that to having a quarter of the team. So probably 25 plus people working on platform engineering and ops. And that's what it took. And it took years of that to turn this around. It took a lot of investments over a long period of time, and it was worth it. And I'm glad that the board and the management team had the sort of fortitude to make those investments and to, stick it out, because I think it paid off in the end. But it was definitely a big investment over a long period of time. It wasn't like a startup where you go through and refactor it and it's fixed tomorrow. It was a whole series of things over a long period of time. So anyway, I think that to me, that was it. Like, somebody needs to own those KPIs and those metrics. And if site reliability is important, somebody besides me, the CTO, needs to own site reliability, somebody that I can rely on to actually go solve that problem. So after the acquisition, I didn't really want to stick around in a PE acquirer. So I left there and went to Census. I followed Brad Brooks, who was the CEO at OneLog into Census, brought in there as a CTO with a team of about 50. Originally just running engineering, and then eventually also taking over product. I think I worked a lot on organizational maturity, on kind of trying to turn the Census engineering organization and SaaS platform into something that looked a little more like OneLogin, that was going to scale, and be able to support growth and, an eventual exit. I think I did some good work there. I've had 6 months to think about it, and I think I've definitely learned some lessons, and I have some ideas about how I maybe could have been a little bit more effective there. But all in all, I think it was a good experience for me. I'm not going to go over the nuts and bolts. When the story of Census is written, I'll add my chapter at that point. Right now, I'm a fan of the company. I'm an investor in the company. I have every confidence they're going to be super successful. So it's a good experience. Probably some things I would have done differently, but and that brings us to present. I'm the solo founder of a company called TeamSpark AI that I've been working on for about 6 months. And the general premise there is, what if there was a social network that was built to bring teams together to foster genuine human connection, amplify positive sentiment, and basically help teams achieve their goals? And if you think about it, really, all of the current social media that we have now started as social networks, but they're not social networks anymore. Facebook and Twitter in particular started as ways to connect with people you already knew, or people that were in interest groups, small groups, to help those people connect. And that was kind of all it did. And Twitter was the same way. Twitter was basically just a group messaging product so that you and a bunch of friends could stay current on something via text messaging. And what all of those things evolved into, because of the advertising model, is essentially mass media, where it's a small number of creators producing a massive amount of content that's consumed like ad infinitum by lots of users. So there's billions of people watching content that's produced by tens of thousands of super influencers for 12 hours a day, without any thought to like whether that's actually good for anybody or the public or their users or their consumers, because their customers are advertisers and data harvesters, and their users are the product. And so I think I struggled a little bit at the companies I was at before with all of the sort of Slack fatigue and some of the other tools that we used, and thinking about, wouldn't it be great if you could think about ways to think about the good things that happen with social networks when they work, and figure out a way to bring that to teams. Maybe that's teams in companies, and maybe that's other kinds of teams. But basically, I think social networking is great and almost doesn't exist anymore, and social media is kind of bad, and then that's what all of our social networks sort of turn into because of the business model. But I think there's a way around that, and I think there's some application of AI that's interesting there. So the next episode is going to be what we've built. I'm not going to really go into a philosophical rant about why, but I'm going to kind of just talk about what the architecture looks like and the pieces and some of the hard parts of the problem. So the learning is still in progress. So let's have some parting wisdom. I think the value of the founding idea is basically zero. I've never heard an idea, even one that somebody thought needed to have an NDA around it, that was so brilliant that I was like, wow, that idea is valuable. The ideas behind the most successful internet companies, or companies in general, are not clever. If you'd heard them at the time, you wouldn't have thought anything of them. It's the team and the execution around the idea that creates the value. The idea itself is worth almost nothing, maybe less than nothing. So my strategy is to talk about what I'm doing, which is part of what I'm doing right now, and in these podcast episodes. And at least two of the acquisitions that I've had happen have been because we were talking about the things we were doing. We were blogging or going to conferences or speaking at events or doing white papers, and somebody noticed us and said, "Oh, hey, what are these guys doing? What is this?" And I feel like that tracks with lots of founders. That founders talk about their ideas all the time to anybody who will listen, probably too much. And that's what you should be doing. You shouldn't, if any idea requires it being kept a secret in order for it to be executed, that's a bad idea that you should run away from. So talk about what you're doing is my advice. I think generally I'm more of a builder than a seller. But in my experience, in the times that I've spent time working on pitch decks and dragging myself down to Sound Hill Road and sitting through all these venture capital meetings and doing all this work to try to convince somebody to pay me to build a thing, in every case, I think I would have been better off just building the thing. And then maybe going back and saying, hey, I've built the thing. Now let's talk about making a business around it. But I just feel like when you wind one of those up and you've spent 6 months of your life and you get nothing out of it, just literally throw it all in the shredder and go on to the next thing because you didn't build anything except an idea and some PowerPoints. So for me, for me as a builder, I like to start with building, and I think it's a better use of my time. And maybe I'm wrong, but that's what I like to do. I think early on you want co-founders and not employees. And there's probably a whole rant on this too, but basically, let's say I'm working now as a tech founder and I'm putting in 80 hours a week building, writing code and building infrastructure. And I think, okay, I need to scale this up. So I need to hire some engineers. So let's say I hired 4 engineers that are just working this as a 9 to 5. They're not co-founders. This is not their mission in life. It's just people that are coming in to do work. Those people aren't going to work 80 hours a week. They're maybe going to work 40 hours a week. They're probably they're going to have lots of meetings and Slacks and spend lots of time talking about other stuff and doing lots of other activities and coordinating between themselves. So their output's probably going to be more like 20 or 25 hours a week of actual coding. So you basically traded your 80 hours a week for maybe 80 or 100 hours a week between these 4 people. And now you have to manage them. So you're going to spend half your time managing those 4 people. And not just coordinating their work and like explaining what they need to do and inspecting their work, but also now you're responsible for their career development and their emotional happiness and who knows what else. So you're now a manager instead of a builder. And then the other half of your time, you're going to spend raising money to pay those people. And then once you've raised the money, now you have a boss. You probably have 5 bosses or 3 bosses, right? Now you go raise some venture money to make the money to pay these engineers. And now half of your time is going to be answering phone calls and running errands for your venture capitalists who are going to have lots of ideas about ways to make the business better. And they're probably right. You probably should do that stuff. But the point is you're going to have a boss or 3. Are they going to call you 24/7, 365 and expect you to answer the phone? You're going to spend a month every quarter putting together a board deck and prepping it and practicing it and delivering it and following up on it. And that's going to be the other half of your job. So now you've got venture investors. So between your employees and your investors, you give away 40% of the company. You have 3 bosses and a bunch of employees who do about the same amount of work that you used to do. So you have to do that at some point. But my advice is wait as long as possible. And I think co-founders is the way around that. You find 2 or 3 co-founders who are like you, who are mission driven, who you have a shorthand with, who are super productive, who don't require a lot of care and feeding and a lot of career development and a lot of emotional support. And I'd rather give them equity and push the product forward before trying to raise money and before sort of building out this employee base and keep that velocity up and keep my hands dirty a little bit, I guess. So that's my personal preference. When you start a company, everybody needs to be on a vesting schedule, even you, unless you bring something pre-existing, some value, and maybe you establish some value, spend 6 months as a team working on something before you incorporate. So you can maybe you get some credit for that for time served. But basically, everybody needs to be on a vesting schedule. And the reason is, like hypothetically, let's say you start a company with 1 co-founder and you're both gung-ho and you're working really hard and then something happens, right? They have a life event happen, they lose their passion for the business, whatever, and they stop working on it. Or they slow way down, or maybe they stop. And now you're still going full blast because you're still invested in this thing. But if you've already split up the equity and you each own half the company, something's wrong there because you're continuing to contribute and build and they're not. They might even have a job. They might even get another job somewhere and be getting paid, and you're working for free on the startup. So everybody needs to be on a vesting schedule, including the original founder of the company. So you're going to take whatever your equity schedule is, and you're going to earn that out over 3 or 4 years, as is every other co-founder. And that way, at least you have some protection against this idea that, hey, something's not working out, somebody's wandering off, somebody's not pulling their weight. And we have a way to control that. Once you take venture money, they're going to force this all on you anyway. So they're going to restructure any cleverness you put into your founding agreements. They're just going to shred and throw away, and you're going to start over, but with whatever they want you to do. But anyway, while it's under your control, everybody's on a vesting schedule. I'm going to say beware of consumer plays, even though it might be like I'm not following a lot of my own advice, frankly, on Team Spark, but consumer plays are hard. It takes a skill set. It takes the right kind of product. It's kind of lightning in a bottle to get something that grows organically, that catches fire. And I can't see any rhyme or reason to it. Like, I have no idea why, some of these things work and some don't. And they're hard, and there's lots of bodies next to the tar pit. Consumer is tough. Like, enterprise, some underserved enterprise, narrow market that you can go dominate is probably a much better way to spend your time and energy than trying to build some, the next version of some big consumer play. And I guess lastly, make sure whatever you build can be extended and operated without you, for a couple of reasons. One is, if you build something that's inexorably tied to your personality and skill set and your knowledge and can't be run without you, then you have now mixed up the value of you as an employee with the value of whatever the thing that you built is. And you can't sell them separately. And I've noticed that in some of our own deals. Like in the first deal that we did, we basically sold the team and the code base, and everything was on a vesting schedule, which means the independent value of the code was zero. Like, if we had all quit on the first day, nobody would have gotten paid anything, and they would have still owned all the code. And in later deals, like the SendMail deal, that wasn't the case. We were able to sort of separate it out and say, look, there's a pile of technology that has value, independent of us, and we expect to be compensated for that as shareholders of this thing. And there's the value of us to continue to build and support and grow this thing. And maybe they're sort of tied together, but they're not the same. They're not exactly the same. And even at large scale, even at OneLogin, we had a team that when I joined required the services of a few specific people for that site to stay up. And if one of those people got hit by a bus, that site was not going to stay up. And it needed to be moved into a state, which we successfully did after a lot of investment, to be able to say, look, okay, now we aren't relying on any one person or even any team of people. Like, this thing can be operated by mortals who we can train to operate it. And I think that's super important, because otherwise any deal you do is just going to be an acqui-hire. You're basically going to be right back into having a boss. Maybe you're going to invest and make lots of money, but you're still going to be in that situation where your value is tied to your day-to-day labor. So I think, to the extent that you can, separate out the value of the thing you built from the value of you as the builder. That's good. You should do that. That's pretty much it for the first episode. The next episode, we're going to talk about kind of what we built around Team Spark. And then I have a bunch of very nerdy, very specific technical issues that probably are going to have much smaller audiences, if that's possible, that are coming down the pike. So anyway, thanks for joining me. Until next time.